Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Great. So now we've talked about this same example where it took us a little bit to get here, but we're here where we now said that we're borrowing $100 at 6% interest. So if this company had no debt, they would have $106 of earnings before tax, and they would have to pay 33% tax on those $106. That's $35 of tax. But we have $6 of interest expense, which we're allowed to basically say that can reduce our earnings before tax from 106 to 100, and 100 times the 33% is only 33. So with no debt, we'd owe $35 in taxes for the year, but with debt, we only owe $33 in taxes.
Okay.
So what happens to our profit, our earnings after tax, if our interest expense goes up by 6 and our earnings before tax goes down by 6?
Well, wouldn't our E also go down?
Yeah, but by how much?
12? Or no, the negative, or no, it would be -4.
Yeah, exactly.
Yeah.
Exactly. This stuff is super dense and complicated. And this is what I mean when I talk about like the language of finance and all of the jargon and it being a series of addition, subtraction, and occasional multiplication. Is like in a vacuum, 6 times a third is 2. And 6 minus 2 is 4, doesn't feel so hard. But now when we're talking about a loan with interest, we have to convert that into the appropriate line item on the income statement, which is interest expense. We have to know where it belongs, and we have to know that there's this tax that gets applied at the end. So any expenses that you incur are a tax shield. So we said that our net income decreases by 4. But now we got to talk about our balance sheet. And we did the first half, which is we have this liability of $100 that increased because we took out the loan. What happens on the asset side?
Well, wouldn't we since we're still assuming we're still bringing in the same amount of cash, like our company is still bringing in the same amount of cash, but we still have to I guess pay our debt off? Would it our assets go down because we're paying that debt off throughout the years?
Yes, but we're also getting the initial cash from the loan.
Okay. So then wouldn't it stay roughly the same since you're getting that, or it would go up because you're getting that cash from the loan?
It would, but interestingly, something happened to our income as a result of this borrowing, right? How did our net income change as a result of borrowing this money?
Well, doesn't our net income go down because even though we borrowed the money, we're still having to pay off the money, so our net income goes down from paying off that money?
We said our net income went down by $4 as a result of this loan. And so in the first year, when we're thinking about our impact to our cash balance, we got $100 that we received from the loan, but over the course of the first year, we also paid $6 in interest expense.
Okay.
So that's $6 that we don't have on our balance sheet anymore. But as we calculated on the income statement, we were able to avoid $2 of tax.
Okay.
Does that make sense? So our net income changed by 4, or went down by 4, so changed by -4. So our balance sheet also changed by 100 minus the 4. So our cash balance increased by 96.
Okay. Okay, that makes sense.
And there are 3 components of that 96, just to revisit. So we borrowed $100, so our cash went up $100.
Okay.
But in that first year, we paid 6% interest. So we had to basically go into our bank account and pay $6 of interest that went off to those investors. So we got $100, but we paid out $6. But on the income statement, we calculated that we were able to avoid $2 of tax at our 33% tax rate because we borrowed that money. And so we saw on our net income, decrease by 4, which is basically a reflection of $6 of interest expense less $2 of taxes avoided. And so on our balance sheet, our cash balance increases by 96.
Okay. So our cash balance, just one more time, our cash balance increases by 96 for that like first year.
Yep. Between 2 seconds before we sign the loan and a year after we sign the loan.
Okay, that makes sense.
And in the if we're looking at the change in our balance sheet from 2 seconds after we sign the loan to a year later, it's just a change in cash of -4.
Okay.
Because our liabilities didn't change because we signed the loan, 2 seconds before the difference. And we are now in an unfortunate situation where our balance sheet does not yet balance, right? We said that our liabilities went up by 100 because we borrowed $100. We said that our cash balance went up by only 96 in that first year because we borrowed the $100. We got the $100 of cash, but we paid $6 in interest. But when we paid the $6 in interest, we avoided $2 in tax. So plus 100 minus 6 plus 2 got us to 96. We have a $4 hole. How do you think we reflect that?
Reflect the $4 hole,
how do we balance our balance sheet?
Balance our balance sheet?
Yeah.
I'm not exactly sure, but maybe it has something to do with bringing in more cash so you can balance your balance sheet, or no? Okay. Reflecting your income, your income statement.
Yeah.
Okay.
It's in that retained earnings line item. And you can always think of the change in retained earnings from balance sheet at time 1 to balance sheet at time 2 as equal to the net income from time 1 to time 2.
Okay.
So our net income from our income statement was -4. So you have a green light to just set your change in retained earnings equal to that income statement number.
Okay. So you just always want to make sure your balance sheet balances, which is why we set that change in our retained earnings.
Yeah. Now, what this does mean is that if you borrow $100 at 6% interest and you do nothing with that money and you just let it sit there, then you are burning your equity value. If I just borrow $100 at 6% interest and I let that $100 sit in a checking account that isn't changing, it's not earning interest, it's not doing anything, you're losing money. So that change in $4 of retained earnings is a real loss. So ideally, if you're going to borrow money, you have a plan that you're going to do something with that money that you're borrowing that will yield a return at some point that is greater than the interest you're paying.
Okay.
Right? What if I told you hey, Olivia, you have this opportunity to borrow $100 at 6% interest and you're just going to do nothing with it. You'd be like, no, thanks.
I feel I would not want to borrow them.
Yeah. When somebody offers to loan you money at some percent interest, the math you should be doing is, what am I doing with this money? And can I earn a return that exceeds that 6%? And actually, I'll go one step further. You don't always even have to exceed the 6% because you get this tax benefit too.
Okay.
So the tax affected interest is really only, we said it's net, it changes your income by -4. So it's really only 4% of after-tax interest impact.
Okay. Okay, that makes sense.
So to recap what we've just talked about, in the scenario where we're borrowing $100 at a 6% interest rate, we always want to start with the income statement when we're trying to figure out impacts of this stuff. And so on our income statement, we said that our EBIT, which is our earnings before interest and tax, is unchanged because it's happening before the interest. But our EBT, our earnings before tax, went down by 6 because our interest expense was 6. That means that with our EBT getting reduced by 6, our tax expense at a 33% tax rate gets reduced by 2. And so when we are able to avoid $2 of taxes but we reduce our EBT by 6, that leads to a change in E, which is earnings, which is net income, which is profit, of -4. So now we can take our -$4 of net income, we can plug that directly into our retained earnings on our balance sheet. Our retained earnings went down by 4 during the period because our net income went down by 4. We borrowed $100 during the period, so our liabilities increased by 100, and our cash balance increased by 100 because we borrowed the $100 for the loan. But then it also decreased by $6 in the first year because we had to pay $6 in interest expense. But then that 6 isn't the full story because we were able to avoid $2 in taxes that we didn't have to pay. So our cash change is plus 100 minus 6 plus 2 for a change of 96. And when we take a step back, we see our assets increased by 96, our liabilities increased by 100, and our equity through our retained earnings decreased by 4. 96 equals 100 minus 4, and everybody's happy that our balance sheet balances. We now have to talk about our cash flow statement for the final and last piece of the puzzle. So first, let's talk about how our cash from... So first off, what's like the answer? Like, how did our total cash flow change? If our balance sheet, like the cash balance number on our balance sheet, we know it increased by 96. What happened to our change in cash flow during that period?
Wouldn't it also increase because
by how much?
96 as well.
Yeah, exactly. So this is like, now the story has to make sense. But the reason I wanted to go through this exercise is something we did not talk about the cash flow statement in the last section, which is there are 3 sections of the cash flow statement. There is cash from operations, cash from investing, and cash from financing. And the goal of all of this is always like the sum total of our free cash flow for the period always should equal our change in cash balance for the period. But what we really want to understand is why the cash changed. And so cash from operations is basically meant to talk about what's happening in the business, like the ongoing operations of the business that affected our cash flow. And so this is going to refer to that -$4 from our income statement. So our cash from operations was -4 because our net income was -4. And there are some other line items that go into cash from operations that I'm not going to talk about right now. But just let's set aside that there's some other stuff there. Cash from investing is going to be another topic that I'm going to talk about later when we talk about capital expenditures. So I'm going to skip over that. And I want to talk about cash from financing, which is basically to say that if you're borrowing money or you're raising equity and you're getting cash as a result of decisions about changing the capital structure of the business, where again, the capital structure is like the sources of where you got the money from in terms of from like debt holders and equity holders. And this section is basically meant to isolate how much of that 96 change in cash is coming from management's financing decisions versus the actual performance of the business. And in this case, what do you think our cash from financing is?
Well, wouldn't we have gained that $96, or would we have
We actually gain more because what do we borrow?
100?
Yeah.
So would it be 196 or no? 106?
Well, how much did we borrow?
We borrowed 100.
And what did we say just now that our cash from operations was?
Didn't we say that it was 96? Or that was that it was
What's our net income from our income statement?
4, that it was
Yeah, -4.
okay, -4.
And so basically the idea is we want to separately account for the fact that our cash increased by 100 due to borrowing money. We want to separate that out from the fact that the business lost $4 in profit during the period.
Okay.
And so we're talking about this change in cash balance that we just said was 96. And I'm isolating that into -$4 of like profit from operations from the plus $100 in cash from financing.
Okay.
And then I'm going to sum all these three things. Our cash from operations, -4. Cash from investing, skip, 0.
Okay.
Cash from financing plus 100. So -4 plus 0 plus 100 is
96.
Yep, exactly. And so now we have our unifying theory of how borrowing money impacts all three financial statements.
Okay.
To recap, borrowing $100 at 6% interest led to an increase in liabilities of 100, which makes sense. On the income statement, we got this counterintuitive result where our net income only decreased by 4 rather than the $6 of interest expense because of the tax shield. And so our cash balance we calculated increased by 96. And then sure enough, our cash flow for the period is 96, but we broke that into -4 from operations, 0 because we're skipping investing for now, and then plus 100 from financing. So as we wrap up here on episode 10, I love audio, but I also realize that if you've never seen a real example of the financial statements before, then that can make it really hard to visualize. So as a quick plug, in the show notes for this episode, I posted a link to a short YouTube video series where Blaze, Olivia, and I walk through a real example of the three financial statements that should help you get your bearings a little bit. And the other thing it shows you how to do is how to easily access the financials of any company online for free. That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.